Freeholds might be a better investment, but they also require more capital and more active management. If you don't have $250,000 saved up or you don't want to deal with managing an older property, then a condo is still a pretty good investment, especially with all-time low interest rates right now. In this video, I'll walk you through what returns to expect and key things you need to keep in mind if you're planning on investing in a Toronto condo today. Before I dive in, remember to subscribe and hit the notification bell so you don't miss other real estate investing videos like this one from our Elevate team. Fundamentally, you're making money from an investment if you're getting more gross returns than your total expenses. In other words, you're making a spread. And when you're borrowing money to invest, then this spread will be magnified because of leverage. If you don't know what leverage means, then you can learn all about it in this video right here. So let's see how this applies to Toronto condos. According to listings.ca, a Toronto one-bedroom condo in December of 2001 was $175,000. At the end of December 2020, 20 years later, the average Toronto one-bedroom condo is now at $590,000. This translates to an annual appreciation of 6.3% per year. If you want, you can argue that past results are no indication of the future. So we can keep appreciation conservative and assume a 3% annual appreciation moving forward for Toronto condos. On top of appreciation, we have rents coming in as well. With a $500,000 condo, right now you can get around $1,875 in rents each month, so that's equivalent to 4.5% of the property price. Of course, owning a condo also comes with costs. Operating expenses on a $500,000 condo is around $550 per month or 1.3% of the property's price per year. We also have to pay interest on our mortgage. Let's assume we're borrowing 80% of the property at a rate of 1.5%. So this equals 1.2% of the property's price. From a net returns perspective, we have gross returns of 7.5% from appreciation and rents minus 2.5% of expenses. This means we're still gaining 5% of the property's price in net returns per year. Next, let's factor in leverage. At 20% down payment plus closing costs, we're somewhere between 4 to 5 times leveraged. This means our actual net return on investment is around 20 to 25% per year, which is really good. Here's what to watch out for. I mentioned at the start that freeholds are a better investment, and it's not just because of total returns, it's also because it has better cash flows, which makes freeholds a safer investment. A condo has lower cash flows, so this means you have weaker holding power, making it a riskier investment. Let's talk about this a bit more. With investment properties, you can't access your appreciation gains each month, so this reduces your actual cash flows. On top of this, you have to repay part of your loan each month, which further reduces your cash flows. So instead of looking just at your net returns, you'll have to stress test your holding power to make sure you can cover all of your outgoing cash flows, operating expenses, interest payments, and principal paydown so that you can eventually capture those attractive annual returns in the long run. We talked about your annual condo ROI being at least 20% per year, but how do cash flows look like? On the incoming side, this is solely from rent at 4.5% of the property's price. On the outgoing side, it's also 4.5% of the property's price. We have operating expenses at 1.3%, interest at 1.2%, plus principal paydown of around 2% per year. This means if you own a Toronto condo, you'll just be getting by with no extra cash flows at the end of each month in the best case scenario. Of course, you'll have to factor in extra bumps along the way. First, those numbers assume no vacancies. Historically, Toronto rental vacancies are very low, but COVID has changed things up significantly with condos. We went from 1.1% vacancies in 2019 to 5.7% vacancies in 2020, so this is something that definitely needs to be factored in as well. There can also be changes in rent. Because of COVID, rents have dropped by 20% year on year in 2020 in Toronto condos. So this is another thing to stress test to make sure you can cover all of your outgoing cash flows when there are drops in rent. Finally, there will also be ad hoc maintenance and repair issues. Having said that, they tend to be less serious because condos are newer and a lot of it is covered by condo maintenance fees. If you need a number, our property management team recommends budgeting around 2 to 3% of gross rents for condos. Now, when you put all of this together and you're in a comfortable position to cover your outgoing cash flows, then condos are still a good investment. In fact, many real estate investors start with condos to get your foot in the door first. Like we mentioned, condos can generate around 20% plus in annual ROI compared to 7 to 10% with stable bank stocks. So condos can help you grow your capital quickly, and if a freehold is something you ultimately want, you'll be able to transition into a freehold investment property faster if you put your investment dollars in a condo instead of stocks. If you need help figuring out what's the best investment property for you, we just released a 2021 Toronto Real Estate Investment Guide with lots of extra details on this. And if you want to talk to us, we'd be happy to do so as well. I'll put a link to the guide and another link on how to reach us in the description below. As always, remember to hit the thumbs up button to let us know you want us to make more of these videos, and also do us a favor and share it with your friends on social media and tag us at Elevate Realty CA. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video.